Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. Today we're diving into a 10Q filing, and let me tell you, it's a real page turner. If you're into accounting, that is. Just kidding, we'll make it interesting, I promise. Think of it as a financial autopsy report of a company feeling a bit under the weather. We're looking at Richardson Electronics. And right off the bat, we see a mixed bag. Sales are up slightly, but profits? Not so much. It's like they're running faster, but somehow ending up in the same place. Let's get into why. It's not all doom and gloom. All right, let's start with the basics of the numbers. First, the assets. So that's the $36.7 million. That's a healthy jump from $24 to $3 million last year. It means that they have more cold, hard cash available. Looking at current assets, inventory dipped a bit, which might be a good thing, implying better sales execution, but also might be worrisome if there is not enough goods to sell. Accounts receivable is pretty much on par with last year. Nothing to see here. Now, on the other side of the balance sheet, the non-current assets, we see property, plant, and equipment decreased, which makes sense since they just sold off a lot of their assets. Deferred tax is also pretty much the same as before. Liabilities are a big indicator of company health. We see that accounts payable has increased, meaning that either they are taking longer to pay or just purchased a whole bunch of inventory. Meanwhile, is lower now than what it was last year, meaning they are paying off some debt or other expenses. Finally, the equity section, the most important part, we see that common stock and Class B shares are nearly on par with where they were a year ago, so not much dilution happened. Retained earnings, however, a critical metric for profitability, has decreased by $4 million. It means they aren't making as much money. Now, let's look at the income statement to see exactly what is going on. Net sales are slightly up from last year, but that doesn't tell the whole story. While there is sales, the all-important has increased, meaning that the company is earning more money per product that they are selling, meaning that they are streamlining their business. However, what offsets that is that their expenses remained roughly the same. This is why that $4 million wasn't reflected in their equity. Now, this is the real killer, a whopping almost $5 million hit on their income statement due to the disposal of the healthcare assets. Naturally, since sales didn't keep up with the costs and this additional expense, we see that they have an operating loss and net loss. It appears that their bet is not working out. Luckily, taxes helped them with a large tax benefit of over $1 million to soften the blow. It seems like the business sold was dragging the company down more than anyone realized. Net loss translates to a 15-cent loss per share of common stock, so the shareholders are taking a hit. Alright, let's move on to the cash flow statement to see where the money is coming from and going. We see that while the company had a net loss, it managed to produce over $4 million in cash from operations, much higher than the previous year. Cash used in investing activities show how much equipment and assets are being purchased, and we can see there is $2 million of items bought here. Now, one of the largest sources of cash comes from disposing the healthcare assets, resulting in almost $7 million. This disposal is the main part of the report. The whole quarter revolves around what is happening in this asset sale. Finally, we see in financing activities that it paid dividends to shareholders. Not all companies pay dividends, so this might be important to shareholders. One thing that's often missed by a lot of companies is the effect of exchange rate changes, which also has a negative impact. The cash and cash equivalents were actually up a solid 35% from last year, an important metric to see. Looking into the notes, the company has some acquired customer relationships and tech. The customer relationships are almost fully diminished. I skipped over some notes about upcoming accounting changes since they don't influence the current financials. They also have a $30 million revolving credit that's unused, meaning they're ready for a rainy day. Tight now, putting everything together, while Richardson Electronics saw a slight uptick in sales. The big story here is the loss they took from selling off a major chunk of their healthcare segment. It was a painful move, but it seems they're betting on a leaner, more focused future. Will it pay off? That's the million-dollar question. From a Warren Buffett-style analysis, there might be some major things that I'm missing, but on the surface, this might be a strong company. Their PMT and GES are seeing growth, but are getting dragged down by healthcare segment. If I were to give Richardson Electronics a grade, it would be a B. While they are still operating, it means they have more potential for the upside in the future. Thanks for tuning in to Corporate Decoder. What do you think about Richardson's strategy? Let me know in the comments below. And don't forget to hit that like button and subscribe for more deep dives into the world of corporate finance.